we have a very special guest here with us today. Please join me in welcoming Jeremy Miller.
Thank you, Saurabh. It's a real honor to be here and talk about the book and my experience in learning from the process of studying these letters and compiling the book. I'm not a professional writer. I view myself much more as a sort of project manager for what I saw as something that was being widely neglected by the value community and the public at large. I mean, everyone knows about Warren Buffett's time at Berkshire Hathaway and how successful that's been. So, last year was the 50th anniversary of his ascension into the chairman role of that company. So we have his 50 letters from that period. But, there was also a period between 1956 and 1970 where he was running a partnership largely comprised of people that he knew. In fact, the initial investors were family members and roommates and people from Omaha that he knew, folks that he was very close with, and he was writing these letters to them. So you can imagine trying to convey a sense of philosophy in terms of how to think about markets, covering this 14-year period, 33 or so letters compared to the 50 that we've all known and loved and studied very closely. I just felt like there was this big swath of wisdom that was being overlooked, coming from Buffett at a time when he was talking to his family members and he was running small sums of money. So the initial partnership was started with 7 other people, $100,000 of their money, $100 that he threw in on his own, and he also taught a class at the time. So I like this slide because it sort of shows him as the teacher, which he really was. So it was a very productive time for Warren Buffett. You had a 29% compounded annual rate of return over the 14-year period. He never had a down year. The markets had several. He never underperformed. He never underperformed the market, right? Which is just really impressive. And there's a quote from 1999, which was obviously sort of towards the peak of the NASDAQ, where he said, "If I was running small sums again today, I think I could do a 50% compounded annual return." And he went as far as to say that he guarantees he could do that. So, there's a lot to be explored here in terms of what you can do when you truly have a go anywhere, do anything strategy. And that's very different from, the position that he finds himself in today, where, he's sort of saddled with more capital than ideas. This is a time where his ideas far outweighed his capital, right? So I've organized this talk in a way that, I ripped off from Charlie Munger, who ripped it off from Johnny Carson, who may have ripped it off from Carl Jacobi, the famous algebraist, who had a view that if you really want to solve a problem, one great way to go about it is to invert the question, right? Think about it backwards. So the talk that I've put together is, a few really sound ways to, avoid success in investing. And the idea is if you can just not do these 3 things, and I'll unpack them for you, you're going to go a long way in finding success. And so let's get started. So the first one is about predictions. We live in a 24-hour news cycle culture where people that claim themselves to be experts are more than happy to get up on TV and hold forth on the outlook for interest rates, oil prices, what's going to happen with Brexit, all sort of backed by a Wall Street culture that benefits from churn in people's portfolio. And, Buffett, as of, the first meeting of the partners, before he even allowed them to write the check, said to them very specifically, I'm not in the business of making predictions on the general stock market or business fluctuations. If you think that I can do this or it's even necessary, the partnership is not for you. And I think that this idea, well, first of all, so a great way to turn your net worth into your broker's current income is to, trade every whim that you have. You think, okay, I have a view. The, EU, Europe, the UK is going to leave the Union, right? So I'm going to sell the market. That's like a terrible idea, right? And the reason for that is because, the world is full of radical uncertainty, and there's a lot of things that you can't predict. So I think one of the distinguishing factors about Buffett from a very early point in his career was that he was very comfortable saying, it's okay to have no idea, right? And he'll say that up to today when it comes to interest rates, et cetera. It's not, it's not about being able to predict everything. It's about having confidence in what you're actually trying to predict, and really the past being the best source for making guesses about what's going to happen in the future and being long term in the way that you think about it. So that is number one. The second really great way to destroy your net worth is to use the market as a source of information as to what you think a business is worth. So, the average investor's experience in the stock market is rather poor, right? I think we all know that. There's a tendency to, buy high and sell low, and it's sort of natural, right? I guess, Stanford's got their first football game coming up next Friday, right? And so if you go to campus, you want to find your way to the stadium. The best way to do that is to sort of follow the crowd. That's a natural thing. But in the market, when you're in agreement with everybody, that can be a really dangerous thing, right? So I would say the market. Okay, so let me back up a bit. So if you invest in equity security, if you buy a stock, right? I would encourage you to think of that as if you're buying a proportional share in the assets of the company, right? And you should value that business, right? And hopefully, you're doing it in a field that you know something about, so that you can make an educated guess as to what that business is worth. So if you and I got together and bought a dry cleaning business, right? And someone walked in one day and said, I'll give you $5 for this place, right? You'd tell them to take a walk, but it certainly wouldn't freak you out, right? That your dry cleaning business is only worth $5, right? The same thing is true about the equity markets, right? You can't let a market quote turn from an asset that you can utilize when it's in your favor to a liability that's going to, take you out of the market. And so that comes down to a concept of what I would think of as true north, right? So if you can't use the market to tell you what something's worth, you can only use the market as the price at which you have the option of transacting, right? Then you need to be able to value the business yourself, right? And here you have this wonderful quote that basically says, being right is not about being in the crowd. Being right is not about, having well-respected people agree with you. Being right is about putting your facts together, right, and then reasoning them through, right, in a sound and logical manner. And if you do that consistently over time, right, that's what's going to give you success. So I just think, again, to Brexit, where, all these folks, they see the television, oh my God, the world's going to come to an end. I mean, forests were felled to create the paper on which Wall Street wrote reports about, the implications of Brexit, right? Literally, I can't imagine. I mean, and they all end with the same thing, which is basically, I think it's going to be bad, but I really have no idea, right? That's the conclusion. So, folks that get scared because of that, and I think they get, it all gets rather accentuated by, the way it's portrayed in the media. And, ultimately for value investors, it's about finding great companies, harnessing the power of compound interest. Fidelity had this great story that I just love. The best performing Fidelity accounts, according to a big study that they did, were of the individuals who forgot that they had an account, right? So, trading is not your friend. Listening to the market is not your friend. Try and figure out what you think a business is worth, right? And worry about your view of its intrinsic value and how it's changing over time, and put the market aside, right? One more point I'll make on this that I really enjoy from Buffett's commentary is that, risk is oftentimes a quantifiable notion to a lot of people, and Buffett thought very differently from almost the very beginning, right? Risk is not beta, right? Beta is the amount by which a stock squiggles, right, over a certain period of time, right? To Buffett, that's not risk. Risk is not knowing what you're doing, right? So maybe you have the wrong facts. Maybe you've thought them through in a way that was internally unsound. Maybe something that you didn't consider came into the picture and your hypothesis was wrong, right? Being wrong is risk. Not knowing what you don't know is risk. Okay. Squiggles don't matter when you're in Buffett's shoes, which is thinking about companies divorced of their stock price, willing to cheer for them to go lower because you don't really care, you don't have to sell, and you're more than happy to buy more. Buffett found himself in these positions where he would buy a little bit and the stock would go down, and his intrinsic value estimate didn't change, so he'd buy a little more, and it would go down. And it would do so for years, right? And he didn't need the market to tell him he was right. It was his own reasoning that led him to that conclusion. The third thing that I think is a really good way to fail is to play somebody else's game. And there's going to be times where value investors feel like they are out of sync with the market. And it's really hard, I think, to stick to your philosophy and your principles when you're in the sort of speculative froth of a bull market, right? So we saw this at the end of the partnership era, which was as we approached 1970, you were in what they called the go-go phase of the market. It was the conglomerate era. And it just predated the Nifty 50, if people have heard of that. But Buffett couldn't find stuff that made sense for him to invest. And so, he returned the capital, right? The same thing happened in the tech bubble. I mean, there was all sorts of articles about how Buffett had lost his way, right? Old fogyism, knew too much that was no longer true. It's a new era, all this stuff. And he told folks that nothing had changed and the market was overvalued. And so for the second time, he issued a warning. So I think this is really important to investors, is to really figure out what you're all about. There's been some really people that I admire so much come here to speak to you that have very different approaches. And something that I struggle with quite a bit for a few months actually was thinking about, okay, we had young Buffett, okay, in the early stages, he's a lot like Tobias Carlyle was, right? He's pure Graham. He's looking for statistical, cigar butts that are super cheap, out of favor. By the end, he's a lot like Tom Gaynor, right? Where he's got, the majority of his funds in American Express, right? He bought Walt Disney. So he went from, buying Dempster Mill, which is a windmill implements company on the verge of bankruptcy, to, high quality businesses that were compounding and were compounders in general, right? And so the question is, what should you do? So I was trying to think, okay, what kind of advice should I be giving? If somebody asked me what's right, and Tobias has got great statistics, he's got all this math that shows, his way is better, right? But then Tom Gaynor's got, this great stat on Graham, which is that, he bought a lot of cigar butts, but guess what? He made more money in Geico than he made in all his other investments combined. So if you find one great compounder and you make 19 other mistakes, you're still bound to do wonderfully well because of the way that compound interest works. So the answer that I came to was that, unfortunately, what should you do? It depends on you, right? Play your game. Figure out what your circle of competence is. What areas are you interested in and passionate about? Where are you apt to be able to have an understanding of what a business is worth, right? And then what is your sort of psychological disposition to being on this treadmill of cigar butts? Because, they are sort of fleeting in their value, and you have to be on a constant search for them, which is very different than what Buffett does now, or Mr. Gaynor does at Markel, which is buy great businesses and sort of sit on your butt, right? So the other thing I will say before I close on this topic is that very early in the partnership, 1959, 1960, Buffett put 35% of the funds in a company called Sanborn Map Company, which was a mapping business used in the insurance field. And the market cap at the time was right around its stated book equity of $4.5 million. Okay, so the inflation factor being 7 or 8, you can be thinking, $35 million market cap. Now that is a minuscule thing, right? So the idea of following Buffett because he bought, Phillips 66, right? That might be great, but if you're at a position where you can sort of put the Geiger counter over some of these micro caps, you should, because there's a lot of fertile ground where institutions can't go. So I would just say, go anywhere, do anything. Don't try and copy anybody. You can look to them to see what you like about what they're doing, what resonates with you. But like Guy Spire said when he was here, don't try to be Warren Buffett. Try to be the best Guy Spire. Try to be the best Jeremy Miller, because that's really the only way that you're going to be able to make it through the tough times, when your strategy is inevitably you're going to come through times where it gets hard. So to invert the inversion, you really need to think long term and get yourself away from making predictions, especially short-term predictions. Forget the market. Carefully assemble the facts, apply sound reasoning, come up with your own value, your own view of what something's worth, and be confident in it before you do anything. Because if you're not confident in your view, you're going to get shaken out of your position. And then third is, figure out what kind of investor you are, what suits you from a temperament perspective, and play that game. Don't play someone else's game. So with that, I thought I'd stop and see if there's any questions.
And see what happens.
Yeah, so the question is sort of the continuum by which Buffett was active and engaged with his companies during the partnership era versus today. Is that fair? And so what I would say, interestingly enough, is Buffett came out of Columbia where he studied with Graham, right? And then he begged Graham for a couple of years for a job at Graham-Newman, and he ended up getting one, right? And at Graham-Newman, it was very much the way that you described initially, this sort of a hands-off approach, because Graham had this view that you should be able to just read the Intelligent Investor and securities analysis and make money, and it would be kind of, we're trying to prove that to people, so don't go talk to, management teams or, get one-on-one access to these things and so forth. But then, as soon as Buffett started the partnership, he moved away from that. And what he did was he had three categories of investing, right? One was called the generals. These were generally undervalued securities, these ultra cheap cigar butt type things, right? And then he had workouts, which is basically just risk arbitrage. One company buys the other, so you bet that the transaction closes. And then the third category was actually born out of the first. So the generals, so for instance, I mentioned Sanborn Mapp, $4.5 million market cap, right? So over time, he comes to acquire, 20%, right? Gets together with some other friends, gets 40%. Forces his way onto the board. Now, Sanborn Mapp was unique because it was asset rich. It had all these securities in its portfolio that it didn't need. It was just making so much money for so long that they bought stocks and bonds. The board was comprised of, people from the insurance industry that didn't own any shares in the company. They didn't care. So if you've read Snowball, this story is in that. He forces his way onto the board, threatens a proxy, right? Does an exchange for, his shares in Sanborn Mapp for the securities portfolio, makes a very nice return, avoids some taxes. So even back then, he was very willing to do what it takes to unlock the value if he had to. So I kind of think of that as him as an activist. Later on, he would buy full, controlling positions in companies. So maybe just one last point on that I think you might find interesting is that, Buffett seamlessly moves between the world of business and investing, right? So a portfolio manager takes a pile of capital, people give them money, right? That portfolio manager then selects the best stocks that they can find to earn the highest return possible. Well, Buffett thinks the same way about a CEO, right? A CEO has a pile of capital. It's in the form of the assets of the company, the working capital of the company, et cetera, the cash, and says, how are we going to deploy these assets to their highest and best use?
So an alternate approach that may be something that, say, a Tom Gaynor would propose is just study businesses that are good quality. And Buffett has this knack of making everything look very easy, but it actually isn't. And so maybe instead of doing what Buffett did in his early years, just study good businesses, and whenever you have a Brexit, you just buy those businesses and hang on to them. And obviously, you're not going to make 30% annualized returns, but for most people, if you do it over 30 years, I don't need to make 30% annualized to do okay. What do you think of that approach?
Fabulous. I think that's a great approach. I mean, if you can identify the field in which if you can identify a field of securities that you think you understand and can value, right, then you can also identify the price at which they'll offer you the compounded rate of return that you're after, right, and that you think maybe you're entitled to. So, and what I mean by that is if interest rates are 10%, the demanded rate of return that you're going to expect from the investment is going to be higher than if they're 2%, right? But if you have a field of, say, 25 businesses that have public equities associated with them, right, you can value those businesses and then determine the price at which they're going to offer you the rate of return that you think you need to make the investment. I think Buffett always used 15. I think now the size of his capital has dropped down closer to 10. But if you're not operating with billions, then maybe 15 is the right number. But whatever that is, I think that's a great strategy, especially if it suits you.
I just had a question regarding what you're saying versus, I guess, what you call the efficient market theory, which is really no individual can actually get more information from the system, legally than anybody else, and it's all built in. And in particular, people do talk about how almost nobody can do better than the indexes. And of course, there's two counter examples, which is Peter Lynch of Magellan and Warren Buffett, of course. And then people say, well, Warren Buffett, you can't really count him because he actually goes and, like you said, gets on the boards and helps manage the company. So he personally takes a role in making the company successful, which obviously most of us can't do. And then Peter Lynch, he had a very strong run, but then once he got out of Magellan and started predicting stocks, kind of his private portfolio actually didn't beat the market. So even, and I'd say all of us here, we work at Google, and yet and so we think we probably know something about the internet business and whatnot. And even I think most of us are pretty astounded by the way Google's performed and continues to perform. And even I'm here for many years, I have no idea what's going to happen in the internet business and the sales and advertising market and so forth. So I'm not sure how I would even apply the things that you're saying personally, even being in the business that I'm in.
Sure. So let me try and unpack that a little bit. So, Buffett's best rebuttal to efficient market theory is a speech that he gave called "The Super Investors of Graham and Doddville," where he played out a scenario of a national coin flipping contest where everybody flipped a coin, and the iterations went daily until there were 20 or so left, and said that wouldn't it be awful weird if all 20 came from the same town, right? And then he outlined the results of what he called the super investors of Graham and Doddville, which were basically a collection of people that studied under Graham or were heavily influenced by his teachings. I will say that during the partnership years, there was no index investing, right? That hadn't been invented yet. But even then, Buffett was making the case that if you can't outperform the market, the index, the general results of the Dow Jones, which is what was the primary one, I guess S&P today, then you shouldn't be investing actively, right? It is the onus of the active investor to outperform, and those who can't outperform are doing a disservice to their investors, by being active, right? In terms of how you personally can go about taking on a value approach, would be to do one, exactly what you started with, which is reject things that you don't think that you can really have a strong view upon in terms of how the future is going to unfold. You know, it may be very different than perhaps, you know, buying a dry cleaner that has an advantaged position next to the train station, you know, in the town in the commuter town and in whatever, XYZ America, right? So looking at the stocks as businesses, I think is the best way to do it when you have a strong view of what those businesses are worth and you're presented with prices in the market that are different than that. I think that's the essence of it. And what those will be dependent on, you know, your own circle of competence, what you know and are capable of valuing, which I'm sure is a lot when you start to think about it.
We were talking, you were alluding to it, I think, before you began the talk. And I was just saying, for the benefit of the audience here, you know, in doing such a deep study of his early years, what are things that stood out to you in terms of, you know, things that have impacted you at a personal level? Not just in investing, but maybe, you know, in any aspect. And if that question were put to you, what would stand out to you?
The way that Buffett went about structuring the partnership, communicating to his investors, was sort of high class from the very beginning. You know, there was a lot of integrity, and it really shines through the letters. That would be one thing. But from a practical perspective, in terms of what really changed the way that I think about investing as a participant, would be this idea of a business as a pile of capital, right? So look to see where the assets are, right? What's the sort of return that's being generated on those assets? Are they optimized, right? Look at the business as if you own the whole thing, right? Even though when you buy the security, you buy your proportional share. You know, what is the whole thing worth, right? If you go to Yahoo Finance to look at a company, don't look at the share price, right? Look at the market cap, right? What's the whole business worth, right? And then, you know, if I buy my fraction of the business, you know, am I getting a discount or am I overpaying? So, you know, the fungibility of the capital, the idea that, you know, business and investing is sort of very much the difference between the two is sort of false in a way. And then I guess the other thing would be to think long term, okay? So compound interest requires patience. It doesn't really kick in until like 6-7 years, depending on the rate, right? But once it goes, it's the most powerful force there is. That's why Buffett used to joke that his haircuts were costing him $200,000 a piece, right? Because if he had foregone the haircut and put the money in the fund, you know, he said $200,000. When I did the math, I came to like $2 million. But you know, the point's the same.
I've found it very hard to reconcile two of Buffett's sayings, and I think you referred to one today, which is, if I were managing $10 million or so, you know, I think I could make 50%, or never mind, I think I can guarantee it, right?
Yeah.
And then I think after he started Berkshire Hathaway as a public company, he's kept on emphasizing it's far better to buy a wonderful business at a fair price than a fair business at a wonderful price, right? And he goes on to say there's never just one cockroach in the kitchen, and buying Berkshire at the textile mill was one of the worst mistakes he's ever made in his life. So I found these hard to reconcile. I'm sure you've thought about these. I'd like your thoughts on these.
Yeah, well, you know, Charlie Munger, the vice chair of Berkshire, was asked a similar question, and his answer was, it turned out we could buy great businesses, and you know, it only cost us a couple points of compounding a year, and what a better life, right? So, you know, I think about this Sanborn situation all the time because it was such a small company, right? I mean, you could almost envision a group of individuals, right, getting a controlling stake in a company that had a market cap of $5 million or $10 million. I mean, that could happen today, right? That's what he was doing, right? So, you know, I think if he's saying, okay, if I had a couple $1 million, you know, I could find these companies, maybe they have a $5 million market cap, right? Maybe they just need to be shut down, or maybe they need to be sold, or maybe they, you know, but you could engineer these type of returns. I think that's what he means. But for the lifestyle that he wanted to live, right? If you want to have a diary with your weekly schedule that, you know, is blank except for like Thursday at 2 haircut, right? Compounders is a really a good way to do it. You know, he made a much better return in a company called Dempster Mill, which he liquidated effectively, right? And then deincorporated to avoid tax, and he made a great return on that. But, you know, the town of Beatrice, Nebraska had headlines about Buffett the liquidator, you know, all the time. And that's not, you know, any panacea in terms of how you want to live your life and be seen. So once he was already rich, I think he sort of latched onto this idea, even though it wasn't maybe the optimal from a return perspective.
I saw a paper called Buffett Alphas, which attributed like a part of Buffett's excessive return to his leverage in his portfolio, mainly through the insurance float. I wonder, do you know how much leverage in his early portfolio?
Yeah. So the leverage that he used was only in the workouts. So within the merger arb business, right? Company A buys company B. You know, if it goes through, there's this spread. Usually, you know, it's a couple percentage points, but you know, the window is short. So, you know, if you annualize that, it gets to like, you know, 6 or 7. But then if you put, you know, 3 turns of leverage on it, then you're looking at 18 or whatever, something along those lines. So, you know, when he was doing those types of things and had high degree of certainty that they would actually close, and you know, he did them sort of sporadically. A lot of you know, these merger arb shops do a ton of these deals, but he did, you know, a few a year, something like that. He was highly confident, and you know, he would leverage those. But the rest of the portfolio was unlevered.
You spent a lot of time, or alluded to, Buffett's skill sort of as a manager, whether it's through special situations, sort of like debt workouts, and a lot of, and you can gain outsized returns from that. But I was wondering how you'd respond to Andrea Frassini and some of the other people at AQR who wrote a paper a few years ago, discussing sort of where does Buffett's performance come from, why he had a 0.76 alpha, why exactly was he able to gain such high returns at a relatively low volatility. And so they had done the analysis, and so they looked, one, at his skill as like a stock selection, and 2, his skill as like a manager in these type of situations. And he concluded that it was due to, it was actually the former, his stock selection ability, whether it was being able to pick low beta stocks, companies with just who had high quality, just very consistent growth, high payout ratios, rather than his ability as a manager to manage like private companies, to navigate corporate restructuring and such. And I even believe they said they also attributed partly to his high leverage. Mm-hmm. So they had leverage of 1.6 to 1. And so this is calculating leverage as assets minus excess cash divided by equity, rather than how you did it with, I think you were mentioning like 3 turns, right? And that's using EBITDA as a multiple. And so, so basically, the central point is that they did a statistical analysis, and they're able to account for like his high alpha due to his ability as a stock selection, rather than his ability to actually have some of these like debt workouts, merger arb, or any of these other, I guess, more exclusive methods.
No, okay, yeah, great question. And you know, just to be clear, when we talk about leverage, we're talking about it on the same basis, right? So the amount of assets that it's being controlled by a given amount of equity, right? So if we've got a 6% return and we lever it 3 times, that means we're controlling 3 times as much assets with a given amount of equity, right? And that's what gives you your 18%. And you know, there wasn't a lot of risk arb in the Berkshire years. There was some, and he wrote about it in the 70s. But the main thrust of your point is absolutely accurate, right? I mean, the qualities of the businesses that he has been involved in have been rather consistent over time. It's financials, it's branded consumer companies, and others where he feels like he has a view on what the business is likely to earn 10 years from now, with not a lot of, or I should say, with what he thinks is a high degree of certainty that he can know what the business is going to look like in the future. And so those kind of things have factors associated with them. So whether it's volatility or the actual underlying volatility of the business itself, et cetera. And then the leverage factor is a huge piece, right? Because not only did he have leverage from the float of the insurance company, which, by the way, was purchased for Berkshire while it was a portfolio holding of the partnership, but also through the leverage of the deferred tax liability associated with the unrealized capital gains on the securities portfolio. So, we can talk about, Buffett and avoiding leverage, but really what he's talking about is leverage that has a due date or leverage that has a coupon associated with it, a principal payment, so an interest payment associated with it. So, float, when underwritten properly, tends to come for Berkshire at a near free cost. And of course, the deferred tax liabilities don't bear interest either. So I think you're right. But I would also say that, I think it's easy. It's not easy, but you can do the statistical analysis and run the regressions and see what the factors were that led to the success. There's a reason why there's one Warren Buffett, right? So I don't know if I would necessarily think that we could just do a quant model and replicate Buffett if we started today with the same factors.
Well, so part of their argument is it's not like the private companies are. Or some of those
sorry. Let me address that. Okay, so I agree with you there as well, and I don't think Buffett wanted to ever get active, right? Nor did he think it was his skill set to get active. I don't think today he wants to be active. The managers don't call, into Buffett once a month to give the numbers and say, here's what I'm doing. What do you think? And Buffett says, okay, well, you should get your working capital down, or, you've got too many fixed assets or whatever. He says, give me great managers and then let them run their business, right? And that's sort of his MO now, right? So he's not really claiming to be, a great cast iron forger. So he's going to buy precision cast parts. The most recent deal he did, $40 billion or so. It's not that he bought the manager and the company. So I think he has a lot more to say about how the capital gets allocated than how the business is run. And that's really where he adds the value.
If you look from the 60s to the late 90s, majority of the returns came from a handful of businesses. American Express in the 60s, and then See's Candies, Coca-Cola, American Express again. And primarily, the reason being that he had a very concentrated bet. American Express was some 30-40%, and Coke was, I think, over 20% of the capital. And Geico also was a pretty significant bet. So when he made these investments, they were out of favor, and he had a differentiated view. And the differentiated view came from he doing scuttlebutt on these companies that gave him these kind of differentiated point of view. He wrote the security I like the best, and American Express, he went around and did all the scuttlebutt. So my point being is, from those lessons, seems like concentration and scuttlebutt, if I am going to be a stock picker, are important. What are lessons from there that we can do today apply if I am in active investing, picking stocks, and if concentrated is the way to go. The counter, just to complete the sentence, is the counter being lots of hedge funds thought that they had a differentiated point of view and they were all in Valiant and it was a concentrated bet. It could always go the other way and kill decades of compounding.
Yeah, absolutely. Love that question, right? So Sequoia funds, right, taken down effectively, reputation was dismantled by Valiant, was created because Buffett's partnership closed, right? The investors who wanted to maintain their exposure to the equity market, even though Buffett was recommending that they didn't do that, he gave them the option. Bill Ron was there, started Sequoia for the partnership, right? So that people that wanted to stay in could, right? Basically following this same strategy, which is sort of like it's like an Icarus strategy, right? I mean, you're flying awful close to the sun. It improves the returns. Your question sort of framed it very well. Part of the reason for the success was he was concentrated in the right stuff, right? Part of the reason for the downfall of the Sequoia funds was that they were concentrated in the wrong stuff, right? So, it works really well as long as you don't make a mistake, I guess is the point. So the degree to which you have the confidence in what you're doing should determine the degree of concentration that you're willing to accept. Because if it goes wrong, it's going to go horribly wrong. If you're concentrated and it's recoverable.
Jeremy,
if you're not.
When I was asking you, alluding to the same issue earlier, you mentioned a brilliant Ben Graham quote about Warren Buffett.
Oh, right. Yeah. So Graham was asked about what Buffett had become in terms of his quality compounder strategy. And he said, I can understand why you're doing it, but it's harder. Right? So I think that's for everybody to decide on their own whether, they find it to be in their nature to be more like Buffett of 25, 26, 27 years old or more like, Buffett at age 40 or age 84 like he is today.
Thank you so much once again for being with us here today. This was amazing. Thank you.